Good evening. I had a couple of you ask me some questions about problem number 3. So, um, obviously we will all have different numbers, but I wanted to give you a couple clues on how to work this. So, first of all, the question that I've received the most had to do with requirement number 3 and how to calculate the cash disbursements for expenses right here. So in my example, it's 19,220 or 20,120 or 24,620 for June. So for that, you're going to have to go back up here and read these instructions. And if you look right here, it tells you that monthly expenses are as follows: commissions, 12% of sales; rent, 4,100 per month; other expenses, this is excluding depreciation, because remember, depreciation is not a cash expense, 6% of sales. And it says assume that these expenses are paid monthly. They also tell you depreciation, but that's not relevant because what we're doing is the cash disbursements for expenses. Okay, so let's take a look at, I'm just going to do April, because once you can figure one out, you can do the others. So we're told that the expenses are as follows: commissions, 12% of sales. Well, April sales were 84,000. If you take 84,000 times 12%, give me a second here, I have to do this with my calculator. 84,000 times 12%, that is 10,180. So that would be 10,180. Then we have 4,100. Hold on a second here. I'm trying to find a pencil so I can write that down. So again, we have 10,080. We have 4,100. That's a fixed cost that doesn't change. And then we also have 6% of sales. So 6% of 84,000 equals 5,040. Hold on, I'm trying to write while I'm doing this. So together we have 10,080, 4,100, and 5,040. Let's add this together. And I get 19,220. So again, this number right here, that one right here, comes from the description number F. Okay, the next question was with respect to the income statement and cost of goods sold. Well, cost of goods sold is calculated as beginning inventory plus the purchases that gives you available for sale minus your ending inventory that gives you your cost of goods sold. So let's take a look where we get these numbers from. So we're looking for beginning inventory. Hold on, it's coming from right here. Our beginning inventory for the quarter was 50,400. Our ending inventory for the quarter is 39,000. So 50,400 beginning, ending inventory 39,000. So let's make sure this is correct. Beginning inventory 50,400, ending inventory 39,000. We have to figure out where purchases is coming from. It's going to be from the exact same chart. Our purchases for the quarter are our purchases for the quarter are 203,850. 203,850. Let's make sure this is right. 203,850. So again, the beginning inventory, the ending inventory, and the purchases come from your required number 2, the merchandise purchasing budget. The next question had to do with, where do I find these numbers? Well, you again have to go back to your various schedules. We had a cash schedule for the 4,310, sorry, for the 4,310, and I believe it was this one right here. Yep. End of quarter cash balance, 4,310. The next item on the balance sheet, I believe, was accounts receivable. Yep, accounts receivable, 45,600. So you may recall that they said right here, sales are 60% for cash and 40% on credit. Credit sales are collected in the months following the sale. So our June ending accounts receivable balance would be from the May sale, 89,000 times 40%. Let me make sure this is right. So if you take 89,000 times 0.4, I got 35,600. Up 45,600. I must have done something wrong. Hold on. Sales are 60% for cash and 40% on credit. Credit sales are collected in the months following the sale. Okay, so we're looking at the ending balance, end of May. So what's in accounts receivable? Should be 89,000. Hold on. 89,000. I gotta do my math here first. 89,000 times 0.4. Keep getting 35. Hold on, I'm cheating here. 114. What are they doing? Ah, right. Never mind. The quarter ends in June, not May. So, sorry. I was focused on May, but the quarter ends in June. So, sales are 60% for cash and 40% on credit. So, 40% of the 114,000. Let me make sure this is right. 114,000 times 40%. Yep, 45,600. So, these are the June sales. 60% were in cash, 40% are still accounts receivable. So if you multiply 114,000 times 40%, you end up with your 45,600. Ending inventory, we've already done that. The ending inventory is right here, 39,000. That gives us our total current assets. Building and equipment net. So you have to go back up here. They had $102,000 worth of equipment net, but then they've also purchased equipment. So let me just add this here real quickly in my calculator. 102,000. They've purchased equipment of 3,300 plus 3,300. And then they said depreciation per month. So this means we have to multiply this by 3. So wait, I gotta make a calculation here. 3 times 765 is 2,295. Hold on. 5,300 minus 2,295. Because it's, yep, okay. I just wanted to make sure I got my math right here. So again, for your equipment, building and equipment, you pick up this balance right here, 102,000. You add the additional 3,300. Then you have to figure depreciation, and they were nice enough to give it to you, and they said it's $765 per month. But you have 3 months, so if you multiply this by 3, you end up with 2,295. Subtract that from 102,000 plus the 3,300, so 105,300. Subtract your depreciation, and you end up with 103,005. So again, a couple of you had questions about how to end up with these balances right here. Obviously, accounts payable, you would get from, make sure I get the right one. Hold on. 1/2 of a month's inventory purchase is paid for the months of purchase. The other half is paid for in the following months. And that says the accounts payable at March 31st are the result of the March purchases of inventory. So 1/2 of a month's inventory becomes accounts payable, and that's how you ended up with the 28,050 in accounts payable. Stockholders, sorry, common stock, I do not believe changed. Let me double check here. Nope, no change to common stock. That was already 150,000 right here, same balance. And then you know how to calculate ending retained earnings. Beginning retained earnings plus the net income minus any dividends, and I don't see any dividends here, so we would not have to worry about that. Double check. And earnings. Yep, no dividends to factor into the retained earnings. Okay, I hope this helped.